Welcome back to the Deep Dive. We're your shortcut to getting informed without drowning in information. Today, we're diving into a really compelling piece from the Macro Butler newsletter. It's got this provocative title, Borrow, Bomb, Repeat.
Yeah. That definitely grabs your attention.
It does. And it suggests we're in for quite a ride unpacking the current global economic and political scene. Our goal today is simple. Give you, the investor, a clearer way to see the big macro trends and, importantly, figure out how they might actually impact your own portfolio.
Exactly. We want to cut through all the noise, deliver the key insights. We'll be covering a lot of ground from ancient debt practices all the way to modern sovereign crises. We'll even touch on the psychology of nations under stress and, of course, get into some practical investment ideas for, these pretty turbulent times.
Okay, let's unpack this then. The Macro Butler newsletter kicks things off with this really vivid picture of the business cycle. They call it Mother Nature's Drama Club.
Yeah, I liked that analogy.
Me too. It describes the economic seasons really effectively. First, you have spring. That's when central bankers are cutting rates, politicians are spending, and growth stocks just bloom.
Right, the recovery phase.
Then comes summer. Inflation starts heating up. That's when commodities, cyclicals, emerging markets, they're the ones shining.
Makes sense. Things are booming, maybe overheating a bit.
Then autumn rolls in. Stagflation starts to bite. Things slow down, but prices stay high. And the newsletter notes, kind of wryly, that maybe only the gold bugs are smiling then.
Of times.
And finally, winter. Recession chills the air, inflation goes into hibernation, and suddenly, cash is king. At least until the whole cycle starts over.
What's really useful here, I think, is how this framework isn't just descriptive. It helps you anticipate, right? Where different assets might do well or not so well.
Exactly. It's a strategic lens.
And the newsletter connects this to Harry Brown's permanent portfolio. They call it a financial crockpot, which is quite good. Designed to sort of stew through any economic weather. The core idea is pretty straightforward. Mix stocks, bonds, cash, and gold. The aim is steady returns without, the ulcer-inducing drama of day trading. It's about resilience.
Building that all-weather portfolio. So, okay, let's zoom in on one of those ingredients, bonds. The newsletter says they're maybe the simplest for people to grasp. They're just debt.
Right.
But maybe we should pause there. What is debt? Fundamentally, we use the term all the time, but its history is, pretty profound.
That's a great question. We do take it for granted. I mean, at its core, it's a borrowed money, could be by a person, a company, a government with a promise to pay it back, usually with interest. Its real power, though, is pulling tomorrow's resources into today. It finances everything from mortgages to huge infrastructure projects, even wars.
Right.
And the newsletter points out just how ancient this is. Back in Mesopotamia, 3000 BC, you had farmers borrowing grain or silver. And get this, when debts got out of hand, sometimes rulers declared debt jubilees.
Wiping the slate clean.
Exactly, to prevent collapse. Then the Greeks and Romans, they used debt for trade, for wars. Medieval Europe saw moneylenders and bonds emerge. Then Renaissance cities like Venice, Amsterdam, they pioneered sovereign debt markets.
So it's been evolving for millennia.
Absolutely. And today it's the scaffolding of global capitalism, underpinning everything. Mortgages, corporate loans, government bonds. The key insight for us now, I think, looking at the current situation, is that while the tools have changed, these basic patterns, accumulating national debt, the sometimes desperate measures to deal with it, they haven't really gone away.
History doesn't repeat, but it rhymes, huh?
Something like that. It's a good reminder when looking at sovereign debt today.
Okay, that historical context is really useful. Now, let's pivot to where the Macro Butler sees a storm brewing right now, specifically Europe. They point to political instability in France and the UK as starting points.
Yeah, they don't mince words.
No, they don't. They mention Brussels lecturing about fighting for democracy, while in the newsletter's view, their own citizens can't stand them. Pretty pointed stuff. Let's start with France. The newsletter uses nicknames. Macroleon for President Macron, calling him a petit Napoleon.
Implying ambition, maybe overreach?
Right, and Beirut de Secours, which means spare wheel for another figure. The source suggests they're heading towards an inevitable government collapse. And then there's this image of France batting its eyelashes at the unthinkable an IMF bailout.
Which the newsletter calls a safety net Wall Street geniuses swore Paris would never need.
Exactly. And the numbers seem concerning. French bond yields highest since 2011. Deficit heading towards 5.4% of GDP. Debt projected to hit 120% of GDP in 2025.
Wow. And Eurostat already had it over 114%, way above Germany's 62.3%.
And the newsletter highlights that even countries like Portugal, Italy, Greece, Spain, the so-called pigs, can borrow more cheaply than France right now.
That's tell.
And it's not just France. The newsletter also looks at the UK. It uses some very critical language, calling the Labour leader Keith's Labour Keynesian prime clown.
Okay, very critical phrasing there. We should stress this is the newsletter's characterization.
Absolutely. The source claims these policies are steering Britain towards an IMF-begging bowl again, drawing parallels to the 1976 bailout. It predicts higher spending, higher taxes, maybe another IMF rescue.
So stepping back, these aren't just political critiques. They're flagging real, tangible financial pressures in major European economies.
Definitely.
And this brings the IMF into focus. The newsletter reminds us it was born at Bretton Woods in '44 to prevent financial chaos. Now it's the world's crisis manager, lending money, but always with conditions.
Conditions are key.
Right. And funding comes from member quotas, which dictate voting power. So as the source puts it, big players like the US, Japan, and Europe effectively call the shots. The Macro Butler goes further, characterizing the IMF as a club of Western globalists that, in their analysis, helps extract resources from emerging markets. Again, that's their specific take on its function.
A very pointed take, yes, highlighting power dynamics. And it gets even more dramatic. The newsletter suggests that if things get really bad in France, Macron might use Article 16 of the French Constitution.
Trance.
Extraordinary emergency powers. The source claims this effectively allows him to rule as a dictator in a modern democracy. And it uses a highly controversial label for Ukraine's leader to underscore its point about potential power grabs during crises. We should definitely note the extreme nature of that comparison from the source.
Understood. So extreme rhetoric highlighting extreme potential measures.
Exactly. Now, the newsletter pivots here to a pretty stark claim. Facing a potential sovereign debt crisis, Western governments seek a distraction. What do you make of that? Is that just cynicism, or is there historical weight behind it?
Well, it sounds cynical, maybe, but history does offer quite a few examples that support this idea. It's known in political science as a diversionary theory of war, or sometimes the scapegoat theory. The basic idea is when things are bad at home, economy shaky, leader unpopular, a government might create or exaggerate an external threat. The Russian bear is the example used here.
Why? To unify people.
Exactly. To unify the population, distract from the internal problems, and, well, tighten the grip of power. It's called the rally around the flag effect. An external enemy can boost patriotism, quiet dissent.
And the newsletter gives examples, right?
It does, and they're quite sobering. The U.S., after 9/11, the Iraq invasion, Patriot Act, draconian financial controls, Argentina in '82 invading the Falklands during an economic crisis.
Germany post-WWI.
Right. Hitler's scapegoating minorities amid hyperinflation. The U.S. again in 2003, invading Iraq based on WMD claims. The Spanish-American War in 1898, using the USS Maine incident to distract from a depression.
Even ancient Rome had a phrase for it.
Bellum externum civil discordium. A foreign war ends civil strife. So the depressingly old playbook.
It really is.
And the newsletter argues we're seeing echoes today, particularly in defense spending. NATO members increased spending significantly from 1.8% pre-war to aiming for 2.76% in 2025, even talking about 5%.
That's a huge jump.
It is. And the source describes this shift starkly. Gutting social programs, diverting capital from productive enterprise, calling it debt finance, suicide, big economic trade-offs.
And there's that leaked memo mentioned. French hospitals preparing for potentially 50,000 wounded.
Yeah, a supposed memo from July 2025 ordering hospitals to prep for a major military engagement, coinciding with Macron vowing to send troops to Ukraine. It's true, that's incredibly alarming, a very concrete sign.
Definitely shifts things from theoretical to, well, potentially real.
And alongside all this, the newsletter flags another development. The Euro CBDC, the central bank digital currency. The ECB is heading towards a decision by October 2025.
It's marketed as being about digital sovereignty and privacy.
That's the official line. But the newsletter warns it could actually lead to unprecedented oversight, becoming a financial cage for citizens, enabling strict capital controls. It raises big questions about money, control, and liberty.
Okay, so we've got debt, potential war, new financial controls. What does this mean for the Eurozone as a whole? Is this contained or could it spread?
The newsletter draws a very direct and frankly chilling parallel to the 2010 Greek crisis. Remember how Athens' bailout didn't solve things? It actually lit the fuse for the wider Eurozone sovereign debt crisis.
Yeah, I remember the contagion fears. Pidge, Portugal, Ireland, Italy, Spain.
Exactly. Panic spread. Yields spiked. The euro took a hit. Bank stocks fell. There was even a flash crash. It showed how interconnected everything is. One spark can start a wildfire.
And the source thinks a French IMF bailout would guarantee a repeat, maybe worse, affecting Germany too.
That's the argument. A French crisis would likely ripple across the entire Eurozone, including Germany, which leads to another crucial warning from the newsletter. When governments can't sell their debt, they don't always just default outright. They might get creative, let's say.
How so?
They point to Italy's panic of 1935. The government did a coerced debt restructuring. Basically, they forced people holding short-term treasury notes to swap them for perpetual bonds.
Bonds that never mature.
Pretty much. The newsletter calls it a confiscation of wealth disguised as a financial instrument. And it explicitly labels Europe a vast Ponzi apparatus destined for either outright default or these kinds of coerced, forced loans.
Wow. Okay, so if Europe is potentially facing this chaos,
Yeah.
and the euro's strength is a mirage, according to the source, where should investors be looking? What's the playbook?
Right. The newsletter argues capital is already moving. They dismiss the idea of European stocks outperforming the S&P 500 as a mirage. Their analysis. The U.S. remains the only place to hide capital from the chaos looming over Europe.
Even with U.S. challenges.
Apparently so, in this view. They note German bond outperformance versus U.S. treasuries has already reversed. And they point to the Citi Economic Surprise Indexes, the U.S. one versus the Eurozone one, as showing this divergence. Basically, capital is fleeing uncertainty.
Okay, so fleeing to the U.S. What's the actual survival playbook, then? The newsletter calls it the age of gold in lots. Sounds dramatic.
It does. The core message is a shift in mindset. Focus on return of capital rather than the return on capital. Preservation first as stagflation spreads.
Makes sense in uncertain times.
Yeah.
What are the specifics?
Okay, several key points. First, tangible assets. Physical gold and silver are heavily emphasized. Called the only reliable hedges against reckless governments and bankers, ultimate anti-fragile shields, and critically, non-confiscable.
Got it. Gold and silver. What else?
Commodities, generally to hedge against fracturing global supply chains. Then, cash management. Focus on short-term U.S. dollar assets, specifically short-dated USD investment-grade bonds and T-bills, duration no longer than 12 months, long-dated U.S. treasuries, deemed uninvestable.
Okay, short-duration U.S. debt. What about stocks?
For equities, the advice is to hunt for specific types. Lean, low-debt, high cash flow champions. Companies that can do well with reshoring, trade wars, rising defense budgets.
Yeah, what to avoid?
Definitely European stocks. They use France's 5-year CDS, that credit default swap, measuring default risk as a canary in the coal mine, warning against S&P 500 outperformance, implying European risk could eventually hit the U.S. Also, a strong warning. Flee financials across all so-called developed markets. Banks tend to suffer badly in sovereign debt crises historically.
That's a very clear, if somewhat defensive playbook.
Yep.
The newsletter finishes with a big thought about a global power shift, doesn't it?
It does, a really provocative one. It suggests that just like World Wars I and II boosted the U.S. to become the world's financial center, a potential World War III is poised to shift that crown eastward toward China and Hong Kong. This would signal the eclipse of the globalist Keynesian agenda, replaced by a multipolar world driven by mercantilist ambitions, a fundamental reshaping.
That's a huge idea to end on.
Yeah.
It really makes you think about these long-term cycles and shifts.
Absolutely. From ancient debt jubilees to potential CBDCs, the tools change, but maybe the underlying dynamics of power, debt, and crisis. Maybe they don't change as much as we'd like to think.
We've certainly covered a lot today, unpacking that borrow, bomb, repeat cycle. It definitely highlights how interconnected and maybe how fragile the global financial system really is.
Indeed. I think the insights from the Macro Butler, whether you agree with all their characterizations or not, serve as a stark reminder. Understanding the bigger picture beyond just the daily news is crucial. It really underscores protecting your capital, being prepared for potentially major shifts. The newsletter leaves us with those powerful quotes too. Thomas Mann. War is nothing but a cowardly escape from the problems of peace. And that Rothschild quote, control the money and you control the laws. For you, the investor listening, maybe the takeaway from this deep dive is that in times like these, real liberty, real liquidity, maybe it resides more in your personal vault, as they put it, than just in the bank. Something to think about.